Hi and welcome to Swissquote's Daily Market Talk. It's Friday, November 15th. The joy across risk assets was tamed by interestingly hawkish remarks from the Fed President Jerome Powell yesterday. So the US yields and the US dollar continue to push higher, and the indices look increasingly concerned to lose the Federal Reserve's oh so sweet support. So good morning. We have a lot to put together today, but I would like to start today's episode with these comments from the Fed President Jerome Powell. So Fed's President Jerome Powell, who is leading a team that started cutting the interest rates with a 50 basis point cut in September by fear that the US jobs market would deteriorate quickly, and added another layer of 25 basis point cut just last week, said that well, the US economy is not sending any signals that they need to be in a hurry to lower the interest rates. Yes, the economic data from the US never sent an alarming signal for the Fed to cut its interest rates at the speed that they did over the past two monetary policy meetings, the last being last week, I insist. But coming up and saying that the US economy doesn't need interest rate cuts in a hurry after hurrying into the rate cuts up until last week sounded strange to me. It actually sounded like, we don't want to say it, but the plans have changed with Trump's election because, last week the economic data was as strong. And to be true, the inflation data released this week wasn't that encouraging either for the Fed those. The US headline inflation rebounded from 2.4 to 2.6%, parallel to market expectations, while yesterday's PPI data surprised to the upside with both headline and core PPI data printing figures above the market expectations. And on top of all that, the initial jobless claims from the US came in lower than expected by analysts. So all in all, the Fed is coming to the realization that cutting the interest rates hurriedly was probably a bad idea. And then the first thing to do right now to rectify the move is just to do nothing in December. So the probability of a December rate cut from the Fed went from 60 to 80% this week and is back to around 60% in the aftermath of all the economic data and the comments from the Fed members. And the US 2-year yield consolidates near the 4.35% level. The 10-year yield flirted with the 4.5% level, with Treasury skeptics eyeing an easy advance in the 10-year yield toward the 5% mark. And while the US dollar extended its gains to the highest levels in more than a year, very well supported by the hawkish shift in Fed expectations. The price action actually makes sense, but the fact that the US dollar has now stepped into the overbought market territory will likely slow the short-term demand for the US dollar and could lead to a minor correction. But still, the price pullbacks in the US dollar should continue to be interesting dip buying opportunities for the US dollar bulls looking for a further and an understandable extension of the greenback's gains against other majors. Because look, the euro dollar actually tipped a toe below the chilly 105 psychological level at yesterday's trading session, on the back of a broadly stronger US dollar, obviously, and also a 2% decline in the Eurozone's industrial production. But the pair rebounded to 105.40 level this morning at the time I'm talking here, as the market hasn't yet digested the idea that the Eurodollar, which was testing the 110 offer 6 weeks ago, is now easing below the 105 mark. But once this information and the reality is digested, the move could materialize. As Mohammed El-Erian put it so well, looking at the good, the bad, and the ugly of the global economy, the Eurozone economies are representing the ugly. So the latter, the weak European economies, topped with Trump's tariff threats and the Chinese growth struggles, actually makes no one envious of the old continent right now. This being said, the prospects of more aggressive interest rate cuts from the European Central Bank actually give a certain support to the European indices, because note that a growing number of analysts out there are now calling for a 50 basis point cut in December from the European Central Bank, and some start talking about a 75 basis point cut, which I think is clearly not happening. But the STOXX 600 index was better bid at yesterday's trading session, partly thanks to more aggressive rate cut expectations from the European Central Bank that actually support valuations, and partly thanks to a nearly 3% jump in ASML after the company projected a sales growth between 50 and 100%. Yes, that's the prediction range, 50 to 100% growth in sales. And today, we could actually see the luxury stocks in Europe do better on news that retail sales in China jumped nearly 5% in October as a response probably to the Chinese government's latest stimulus measures, and also on belief that a part of that spending from the Chinese certainly ended up in Vuitton bags. But note that the encouraging data did little to cheer up the CSI 300 stocks this Friday, and the index is down by 0.50% at the time I am talking here right now. And elsewhere, well, even crude oil is not giving a positive reaction to, well, today's encouraging Chinese data. In fact, oil's positive attempt yesterday, well, remained short-lived yet again, and the barrel of US crude is drilling below the $68 per barrel level at the time I'm talking here this morning, and that despite the encouraging news from China earlier in the session. And the dollar CAD extends gains above the 140 mark on weak oil, and the dollar yen consolidates and extends its own gains above the 156 mark, with the yen bears eyeing nothing less ambitious than a further extension toward the 160 mark, where the Japanese authorities will probably say stop to the bleeding in the Japanese yen with a direct FX intervention. Anyway, elsewhere, well, Disney jumped more than 6% at yesterday's trading session after releasing better than expected third quarter results, especially for its streaming business. But unfortunately for the rest of the market, well, the rest of the market didn't look as great as Disney did. The S&P 500, Nasdaq, Dow Jones, and Russell 2000, they all fell yesterday on Jerome Powell saying all of a sudden that, well, there is no need to hurry with the interest rate cuts. And Tesla, Trump's BFF, Elon Musk's Tesla, fell nearly 6% as well. And that was on news that Trump would eliminate the $7,500 consumer tax credit for electric vehicles. But wait, because Trump wants to do something to hurt Elon Musk, who spent $130 million US for Trump's election campaign this year. And people simply think that because Tesla is already profitable, well, it will be in a better position than the rest of the EVs to thrive and doesn't need the credits as much as they do. Other than that, vaccine makers took a big hit yesterday on nomination of a vaccine skeptic man as the Secretary of Health and Human Services in the US. Now, this week, which was full in emotion for investors, will end with the UK's GDP update, a few more inflation numbers from the Eurozone countries, and the US retail sales and the US industrial production data. Now, generally speaking, the incoming data could give an immediate reason to buy more US dollars to investors, or just let the US dollar soften a little bit to buy later at a dip. But the week ends with a strong preference for the US dollar against major peers, as you see. And next week, investors' attention will be shifting to Nvidia earnings. Hallelujah, we can talk about something else than Trump. So the company is expected to reveal another blowout quarter and will probably give a strong forecast for the future, as well as the company CEO Jensen Huang was saying earlier. Remember that the demand for his Blackwell chips was insane. Remember that? So I can't wait to see how insane that demand is. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.